You're being told a story. It's a simple story, a comforting one. You hear it on the news, you see it in the headlines, and you get it in the briefings from your financial advisor. The story is this: the stock market is at a record high. Your 401k is soaring. The system is working, and you, my friend, are getting richer. But what if that's a dangerous illusion? What if I told you that since the start of 2020, the real value of the stock market has been telling a completely different story? And what if the numbers you see on your statement are lying, not just bending the truth, but actively hiding what's really going on? In this video, I'm going to show you the data that pulls back the curtain. This isn't a conspiracy theory. It's just math, it's history, and it's about what money really is. I'm not some Wall Street insider trying to sell you the official story. I'm an educator and analyst, and I spend my days digging into macroeconomics, Fed policy, and the global money system to figure out what's actually happening. My goal is to break down these huge, world changing ideas so that everyday investors, people like you, can see the game for what it is and protect themselves. Because right now, you think you're winning a race, but you haven't realized the finish line is being moved farther away with every step you take. What you're about to learn will change how you see your investments, your savings, and your wealth forever. So let's get to it. Let's start with the official story, the one plastered all over the news. Since the beginning of 2020, the S&P 500 has been on a tear. If you had put a lump sum in at the start of that year, by late 2025, your investment would have ballooned by over 112%, including reinvested dividends. That sounds incredible, right? You more than doubled your money in less than 6 years. Home prices tell a similar story, jumping by more than 47% in the same period. On paper, it looks like we're in a golden age of wealth creation. Your account statements have never looked better. But here's the question that should be keeping you up at night. If we're all getting so much richer, why does everything feel so much more expensive? Why does it feel like you're working harder just to stay in the same place? This is the great disconnect of our time. Your 401k shows a bigger number, but that number's power to buy you the things you actually want and need is shrinking right before your eyes. You feel it at the grocery store when the bill for the same cart of food is 30% higher. You feel it when your car insurance premium jumps another 20%. You feel it when you look at the housing market and realize that even with your record high portfolio, a down payment is even further out of reach. You are not imagining it. That feeling in your gut, the anxiety that something is deeply wrong, is backed up by data they don't feature in the headlines. While your assets were supposedly booming, the official Consumer Price Index, or CPI, has jumped by a cumulative 25% since the start of 2020. And as we'll get into, many argue the official CPI is a generous measure of the real inflation hitting your wallet. The cost of living has exploded. Yet, according to the Bureau of Labor Statistics, real wages for the average American, that's your pay after you account for this official, and some would say watered down inflation, have struggled to keep up. Think about it. The paper value of stocks has more than doubled, while the financial reality for most people has been stagnation or even decline. This is the great financial illusion. You're running faster on a treadmill, you're sweating, your legs are burning, and the dashboard says you're hitting record speeds. What you don't see is that the entire treadmill is on a train that's moving backward. This illusion of progress masks a terrifying reality. Your purchasing power, the only true measure of wealth, is getting hammered. The numbers on your screen are going up, but the value of those numbers is going down even faster. The real questions are, how is this happening and why? To understand this magic trick, you first have to get your head around a concept they don't teach in school. The US dollar isn't money in the way gold was money. It's a product, a currency whose value is set by supply and demand. For centuries, money was like a fixed yardstick you could use to measure the value of everything else. Today, that yardstick is an elastic band, and the people in charge won't stop stretching it. So, how did we get here? Let's rewind to 2020. When the world shut down, the Federal Reserve and the US government unleashed monetary and fiscal stimulus on a scale nobody had ever seen. They created trillions of new dollars out of thin air. The M2 money supply, which is a broad measure of the dollars in the economy, just exploded. At its peak in early 2021, the year-over-year growth of the money supply hit nearly 27%. Let that sink in. In a single year, the total supply of US dollars went up by more than a quarter. It was the fastest expansion of the money supply in American history. Think of the economy as a big pot of soup. The flavor comes from the real ingredients: productivity, innovation, hard work. When the Fed prints trillions, it's like they're pouring tanker trucks of hot water into the soup. Sure, the volume goes up, but the soup gets diluted and tasteless. Every dollar you already had loses some of its value. It's purchasing power. This is inflation. It's not some mysterious act of God like politicians claim. It is a direct result of devaluing the currency. But here's the most sinister part. This new money isn't spread around evenly. It doesn't just show up in everyone's mailbox. This brings us to the Cantillon effect, named after an 18th century economist. Many economists believe it's the single biggest driver of wealth inequality today. The Cantillon effect says that new money enters the economy at specific points, right at the top, closest to the money printer. In our system, that means the new cash flows first to the US Treasury, the big banks, and the massive corporations who can borrow it for next to nothing. They get to spend these new dollars first, while prices are still low. They take this cheap capital and dump it into financial assets, stocks, bonds, real estate. This is what pumps up asset prices and creates the record highs you see on TV. By the time that money trickles down to you, the small business owner, the wage earner, the game is over. Asset prices have already gone to the moon. The cost of gas, rent, and groceries has already adjusted for the now diluted currency. So the people at the top get the benefit of the new money, while everyone else gets stuck with the consequence, a higher cost of living. It's a hidden tax on the poor and the middle class. It's a massive systemic transfer of wealth from people who work for a living and save dollars to those who own assets and are closest to the money spigot. Your savings are being devalued to bail out the system, and your reward for being responsible is watching your purchasing power get stolen. And to add insult to injury, the official narrative tells you it's not that bad. The Consumer Price Index, the CPI number you hear every month, has long been criticized for not reflecting reality. The basket of goods it measures is constantly being tweaked with things like hedonic adjustments and substitution. If steak gets too expensive, they just assume you'll switch to chicken. If a new iPhone costs more but has a better camera, they don't call the price increase inflation. They call it a quality improvement. This is how they can report cumulative inflation of around 25% since 2020, while the real world cost of a middle class life, a house, a car, and education has shot up far beyond that official number. They've built a system where asset owners get rich from the inflation, while the government tells everyone else that inflation is under control. It's one of the most brilliant and frustrating cons in financial history. If you're starting to feel that pit in your stomach, good. It means you're waking up. You're starting to see how the system is designed, and it's not for your benefit. If you're ready to understand how to protect yourself and maybe even get ahead in this environment, you need to know what to do next. But before I show you the proof, the cold, hard numbers that shatter this illusion, I want to invite you to join a community of people who are figuring this out together. If you want my deep dive analysis, my research on Bitcoin, and my frameworks for navigating this change sent right to your inbox, sign up for my free newsletter. The link is in the description. It's more than a newsletter. It's for people who refuse to be misled and are ready to take back control of their financial future. Don't wait. Join us. Okay, let's move from theory to proof. How do we prove the stock market's record highs are an illusion? Simple. We change the scoreboard. If your measuring stick, the dollar, is shrinking, then using it to measure your wealth is like trying to measure a building with a ruler that's melting. The only way to see the truth is to measure your assets against something honest, something with a more stable or even fixed supply. Let's start with the oldest, most trusted money in human history, gold. For 5,000 years, gold has been a universal store of value. Its supply is scarce and only grows by the small amount that can be mined from the earth each year, about 1 to 2%. It can't be created out of thin air. So what happens when we price the S&P 500 not in dollars, but in ounces of gold? The picture changes completely. On a long-term chart of the S&P 500 priced in gold, the true peak for stocks wasn't in 2025. It was back in 2000 during the dot-com bubble. Since then, despite all the roaring bull markets you've heard about, stocks have been in a long-term bear market against gold. While the S&P 500 has climbed in dollar terms since 2020, it has struggled to keep pace with gold. Much of that growth was just a reflection of the dollar's decline. It wasn't that the companies became dramatically more valuable, it's that the dollars used to price them became dramatically more common and less valuable. And who's quietly admitting this? The very central banks in charge of the system. For the last several years, central banks around the world, especially in countries like China, India, and Turkey, have been buying gold at a historic pace. In 2022, 2023, and 2024, they collectively bought over 1,000 tons of gold each year. Why would they do that? Because they see the writing on the wall, they know they are overexposed to the US dollar, and they are actively moving their reserves into a neutral, hard asset that can't be devalued by another country's policies. They're changing their scoreboard even while they tell you to keep yours priced in dollars. Now let's take it a step further. Gold is scarce, but there's an even newer, even harder asset that has emerged: Bitcoin. Bitcoin is the first asset in history with a mathematically proven, absolutely fixed supply of 21 million units. Its supply schedule is transparent and can't be changed by anyone. It is the very definition of scarcity. So, what happens when we price the S&P 500 in Bitcoin? This is where the headline of this video comes from. Since the beginning of 2020, when priced in Bitcoin, the S&P 500 has collapsed. While the exact number fluctuates, some analyses show that despite its dollar-based record highs, the S&P 500 was down by over 80% when measured in Bitcoin. Let's be very clear. This isn't to say the S&P 500 companies are worthless. It's also not to ignore that Bitcoin has been an incredibly volatile asset on a meteoric rise. A $100 investment in Bitcoin in early 2020 would be worth far more than the same investment in the S&P 500. The point of this comparison is to serve as a powerful thought experiment that exposes the deep weakness of the denominator, the US dollar. When you measure an index of the 500 most powerful companies in America against an asset with a truly fixed supply, you see that the stock market hasn't just been going up. It's been desperately trying and failing to outrun the pace of currency debasement. The S&P 500's rise in dollar terms is a mirage. It's like watching a helium balloon rise and thinking it has its own power without realizing the air around it is just getting thinner. And the institutional world is finally catching on. The launch of spot Bitcoin ETFs in 2024 was a landmark moment. It was the financial establishment finally giving a regulated, accessible bridge for trillions of dollars in managed capital to flow into the hardest money ever created. And the inflows have been massive, signaling a monumental shift in finance. The smart money is no longer just hedging with gold. They're starting to allocate to the new digital standard. None of this is new. History is a graveyard of empires that thought they could print their way to prosperity. The pattern is always the same. Go back to ancient Rome. The denarius, a silver coin, was the bedrock of global commerce. Under Emperor Augustus, it was nearly pure silver. But as the empire overextended itself with endless wars and a bloated government, emperors found an easy way to pay the bills. They started debasing the currency, melting down the coins, and reminting them with less silver and more cheap metal. For a while, nobody noticed, but soon it took more and more of these debased coins to buy a loaf of bread. Faith in the money was lost, commerce ground to a halt, and the economic collapse helped bring down the Roman Empire itself. Now, jump to 1920s Germany in the Weimar Republic. Saddled with impossible war debts, the government fired up the printing presses. The result was hyperinflation. What's fascinating is that during this time, the German stock market went parabolic. Someone looking at their portfolio would have thought they were a billionaire. But that wealth was a total illusion. While their portfolio multiplied, the price of a loaf of bread went from a few marks to billions. The stock market's record high was a cruel joke. From Rome to Weimar to modern-day Argentina and Turkey, the story is the same. Currency debasement leads to soaring asset prices that create an illusion of wealth while the average person's purchasing power is destroyed. What connects all this to us today is the US dollar's role as the world's reserve currency. This gives America what's called an exorbitant privilege. Because the world needs dollars for trade, especially for oil, there's constant artificial demand for our currency. This allows the US to run massive deficits, spending way more than it produces, and finance it by printing more dollars and issuing more debt, which the rest of the world has been forced to buy. This has created a dangerous imbalance. The United States is now the largest debtor nation in history. Our net international investment position, the difference between American-owned assets abroad and foreign-owned assets in the US, is a staggering negative $26 trillion. This means the rest of the world has a $26 trillion claim on our future production. It is an empire of debt, and it is unsustainable. And the world is waking up. We're seeing a global rebellion against the dollar system. The BRICS nations, Brazil, Russia, India, China, South Africa, and their new allies, are actively looking for ways to trade with each other in their own currencies. We're also seeing the explosive growth of alternative payment systems like stablecoins, which settled over $27 trillion in transactions in 2024, rivaling players like Visa. Although the comparison isn't perfect, as stablecoin volume includes many non-retail transactions, the trend is undeniable. The world is looking for an off-ramp from a system that forces them to fund America's spending and import our inflation. The reign of the dollar as the undisputed global standard is ending. We are moving into a multipolar currency world, and the transition will be chaotic. This isn't a prediction for tomorrow, but a description of a multi decade process that's already underway. So, what are you supposed to do? The answer isn't to panic, it's to become aware and act deliberately. What I'm about to say is not financial advice. I am not your investment advisor. This is an educational framework to help you think differently about wealth. First, and most importantly, change your scoreboard. Stop measuring your wealth only in a unit that is designed to lose value. Start tracking your net worth, not just in US dollars, but also in ounces of gold. And if you're willing to do the research, in Bitcoin. Create a simple spreadsheet every month when you check your accounts, calculate your total net worth. Then divide that number by the current price of an ounce of gold and by the current price of one Bitcoin. This simple act will be a revelation. You'll start to see the true direction of your wealth. You will see that even when your dollar portfolio is going up, your wealth in real money terms might be falling. This new scoreboard will deprogram you from the official story and ground your financial decisions in reality. Second, understand the game you're playing. The goal isn't just to stack up the most dollars. The goal is to preserve and grow your purchasing power. This means you have to think of your dollars not as a savings account, but as a hot potato. It's a tool for short-term transactions, but a terrible long-term store of value. You have to find ways to trade your depreciating currency for assets that can't be so easily debased. This leads to the third step, building a resilient framework. For many, this means consistently converting their dollars into harder assets. A time-tested method for this is dollar cost averaging. Instead of trying to time the market, a fool's errand, you commit to buying a fixed dollar amount of your chosen hard assets, whether it's gold, silver, or Bitcoin, on a regular schedule, no matter the price. This takes emotion out of the equation and ensures you are systematically opting out of a melting currency and into verifiable scarcity. This is not about getting rich quick. It is about not getting poor slowly. It's about building an ark before the flood. We have covered a lot of ground. We've seen how the stock market's record highs are a symptom of a devaluing currency. We've uncovered how money printing through the Cantillon effect systematically funnels wealth from the many to a select few. We've looked at the hard data, pricing assets in gold and Bitcoin to see the collapse in real value that's being hidden in plain sight. And we've seen how history shows us exactly where this road leads. This great monetary shift isn't a matter of if, but when the tectonic plates of global finance are moving. The illusion of wealth from printing money can last a long time, but it can't last forever. Eventually, faith is lost. And when it is, the transition is fast and unforgiving. The choice you have is to stay asleep, trusting the official story until it's too late, or to wake up, see the world as it is, and start taking steps to protect yourself and your family. The monetary system is fracturing and a new one is being born. The only question is, which side will you be on? Let me know your thoughts in the comments. What was the most shocking piece of data for you? How are you preparing? If all of this feels like the missing piece you've been trying to understand, don't stop here. Every week I send out a free market update that goes deeper than these videos. Real charts, real macro analysis, zero fluff. It's the information I wish someone had given me years ago. And right now I'm recording a brand new macro class that will walk you through the entire monetary system, step by step. Newsletter subscribers will get first access before I release it anywhere else. Click the link below and get on the list. Thanks for watching. I'll see you in the next one.